Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into this edition of Phil's Tax Hacks and Other Retirement Facts with Phil Putney and myself. And this week we are going to talk about the Biden tax proposals, cover some things that you found interesting on the proposals that they've put out there thus far. So you've got this interesting little PDF here from the Tax Foundation we're going to go over. So let's just jump into it here.
Well, before we get too far into it too, let me just throw the disclaimer out there that this is all based on, what his tax proposal was, as a candidate, or nominee, So, I mean, this is, you've got to take it with a grain of salt because you hear a lot of stuff when a candidate's out there, pitching their side of the equation, trying to get elected,
right?
How much that actually happens. It's not something that they can just magically wave a wand and they get the privilege of doing all this. They've got to go through the channels of getting the both sides of the House and Senate to come together and put together a law before it actually becomes law, so you can do something with it. So
right, these are just proposals.
These are proposals, so it'll give you, if nothing else, at least a glimpse of maybe where his mind's at, so to speak, of his thinking on taxes. So yes, I mean you heard it throughout the campaigning that he's really primarily from an individual standpoint targeting those that are making more than 400,000.
Okay.
So the first piece of it is Social Security tax. Right now, Social Security is capped on or taxed for up to 137,700 of wages.
Okay.
His proposal with that is creating almost this donut hole where that stops Social Security tax. So Social Security is really two components. The employer and employee both pay 6.2%. Mm-hmm. So together, the 12.4, if you've heard it from Social Security. But the proposal is it stops at 137. So you reach that holiday, so to speak. If you're making more than 400, though, then Social Security picks up again at 400,000 and above in taxable earnings.
Okay.
So this is basically
so
either
from 137 to 400, it takes a break.
Is the donut hole, they're calling it now. Kind of like you've heard of the donut hole in Medicare. Well, this is the donut hole for Social Security now that they're coining it. So yeah, it's 0 to 137, you're going to pay as an employee the 6.2%. You'll have this break, this donut hole, so to speak, from 137 up to 400 and above.
Right.
You're going to pay the additional 6.2 again, and there's no cap. So that's one of their answers to help, prop up or shore up Social Security is here's this extra revenue coming in from Social Security, because that is what it's for, is Social Security. The other thing is going to be for those, again, higher earners above 400, taking the top tax rate from 37 back to 39.6. The Tax Cuts and Jobs Act is set to expire at the end of 25 already. He doesn't mention that anywhere in any of this.
Right.
So the reality is this is going to happen anyways, not just for those over 400, but for everyone. It's going to revert back to what it was again, unless they come in and change something.
Right. Yeah. Yeah. And so a lot of this is probably fairly similar with a few tweaks to what was under the Obama administration.
Right.
So it's either just let it sunset and it goes back, or, propose a new bill and try to get it pushed through, which, if they don't have the Senate, may or may not, so on and so forth.
Yeah. So it's, if they can get it through.
From a tax
So we'll have a little bit of a heads up of, hey, this is going to happen.
Yeah, we've got a little time if we're still thinking about doing conversions, for example, and knowing what the current tax rates are and things of that nature. Yeah. That could still stay in place for a while.
So one of the other pieces is long-term capital gains.
Okay. Let's talk about that.
I mean, right now there's this lower tax rate, either 0, 15, 20%. You could get into the Medicare surtax of almost another 4% on capital gains.
Okay.
What he's proposing is, again, for those, in this case, it's above $1 million of income.
Okay.
So targeting Wall Street basically is where it comes down to. The capital gains rates go away and you're going to pay 39.6%. So again, that's not going to affect many people because that's $1 million.
Right. And what about the step up?
But yeah, so the piece that's in there that I don't think a lot of people has picked up on is eliminating the step up in basis for capital gains. So how this works is under the estate tax law, and this is another thing he's talking about changing, is reverting some of that. But under the estate tax law, they didn't feel it was fair to tax an estate when somebody passed away, and then also tax the beneficiaries on value, so the gain, so to speak, of a piece. And a lot of this applies to real estate usually. So they've given what's called a step up in basis. So for instance, your parents, bought a piece of property for $50,000 and now it's worth $1 million.
Right.
Well, if they were to sell it, they've got this $950,000 gain that they'd have to realize. If they pass away, because technically the $1 million, the value is part of their estate and potentially subject to estate tax, although with the limits, they're not going to pay estate tax.
Okay.
There's this step up in basis. So you now inherit that property at $1 million as your cost basis. So you turn around the next day and sell it, you don't have any gain. So that 950 kind of goes away. So what they're talking about is eliminating that. So this is not just for those over 400,000. This is everyone.
Right. Yeah.
So we're talking all sorts of little estates out there. So you think of, your parents that maybe they worked for one of the, larger companies in the area, bought stock. They don't even know how much they paid for it because they've owned it for so many years and dividend reinvested. But it's definitely a very low basis. There's a lot of built up gain. They probably held on to it with the thought of, well, we'll let you inherit it.
Right.
And you don't pay tax on it. Or real estate. I mean, this is a very common in real estate.
Which is kind of surprising. So we would not have to pay the taxes on it.
Well, we would under the new
new one. Yes, I'm sorry. Yeah. We're currently not. We wouldn't have to.
Yeah.
Or we would have
it's a huge benefit now that don't, and very common in real estate where, real estate professionals will kind of roll property to property. So do what they call a 1031 exchange, one property to the next, not paying tax, just that rolling that gain forward. Then if they passed away, passes on to their heirs tax-free. Great strategy. But
some of these things are probably designed to help us recoup, pay down some of our debt, right? I mean, these are tax generating avenues for the fact without having to necessarily just levy heavier taxes. At least I'm hoping anyway.
Right. Yeah. And I mean, to me, I've talked about clients for years about this step up in basis going away.
Right.
It's one of those things. I think it's the disconnect between the person paying the taxes and the assessor of the tax, so to speak, because it's same scenario in our medical field today, right? I mean, if you really knew what the doctors and the hospitals and that were charging and you had to pay for it, you would be livid. But you never see it because it goes to the insurance company. All you know is my deductible is $20, or copay or whatever it is.
Yeah.
Same kind of concept here where at the end of the day, now this is the individual inheriting it.
Yeah.
And that's kind of down the road to today when it's happening, all this pieces, legislation gets put into play. Those people haven't inherited properties yet. They don't even know this is happening to them. When all of a sudden now this is in place and you inherit assets 2, 3, 5 years down the road, if this is in place, and all of a sudden you got a big tax bill when you didn't realize, well, hey, wait, I didn't think this was going to affect me. He was talking about 400,000 and above. What do you mean?
Yeah. I'm not there. Right. But yeah.
Yeah.
So something to definitely be mindful of, and certainly if you're in that scenario where that might apply to you, have some conversations with your advisor so that you can figure out a strategy before this. Again, who knows when this gets implemented, but
right. Or if it does,
or if it does, true. Yeah,
right.
Fair.
So,
the doctor thing got me thinking at one time a couple of years ago, and I don't know how much of this is accurate, but I took my dog in to have her ACL repaired on her leg, on her back leg, and it was like $2,500 to get her leg fixed. And I said, first of all, I didn't even know a dog had an ACL, and then you could repair it, and he's like, yeah, I said $2,500. And I said, man, he goes, well, you figure if you went in to get yours done, it'd be about 25,000.
Yeah.
And he goes, one of the funny part is they probably could do it for the same amount of money as that we're doing this dog's leg for. Yeah, it's a little bit bigger, but he's like, and I was like,
same exact concept in surgery.
Same concept, same surgery. He's like, yeah, but it's really insurance and the legalities that drive these things up. To your point, if people really knew or really kind of bothered to look at it, just the amount of insurance that all the doctors at various different fields have to carry is crazy.
Oh yeah.
Yeah. Just the amount of insurance coverage. And that's one of the things that jacks the prices up.
Yeah. I've always said, if you want to fix healthcare, we need to minimize the insurance company's role and bring it back to the people.
Yeah.
If you think of back in the day, so to speak,
yeah.
When insurance was that catastrophic type event is what you look for, and when you were paying all the smaller stuff, doctors and hospitals had to be more conscious of what those fees were.
Yep.
So
yeah.
Anyways, that's a whole nother
podcast
to get on.
Yeah. Insurance and legality fees and lawyers. No offense to our insurance and lawyer friends, but those are just some of the areas where changing a few things could make a substantial difference in that. But again, that's a whole nother soapbox conversation to have. But,
back on the estate tax, one of the other provisions he's looking at is rolling everything back to 2009 levels.
Okay.
Which again, part of this is under that Tax Cuts and Jobs Act is going to get rolled back anyways. So again, people aren't thinking about that. Today, the estate tax doesn't kick in for an individual till $11.5 million. So for a married couple, it's at $23 million of taxable estate. That's the top, quarter of 1% or some very small fraction of the country that is even subject to that. Funny thing is, I can remember back when I started in this industry, that was 600,000.
Oh, wow.
Back then, it was a big deal. There was a lot of estate planning that was done, and it's been increased over the years. But what they're talking about here, the 2009 level would be 3.5 million, which again, that's a big number.
That's a big number, yeah.
But if you start to consider, those retirement plans, houses you own and life insurance, if it's not properly titled and owned, you can get to 3.5 million pretty quick.
That's a good point. Yeah.
So you've got to think of it. It's one of those things that it's not out of reach anymore.
Right.
And one of the other pieces that there was a lot of estate planning that used to be done around maximizing this exemption for husband and wives. That's where there used to be all these spousal trust, and you'd put so much in this trust and so much in that trust.
Right.
So you could get 3.5 million each, because if you didn't structure it that way and things weren't in the first spouse's name that passed, his or her 3.5 million just disappeared. And now everything passed on to the spouse, and they only had 3.5 million. So there was all sorts of strategies of how do you maximize that.
Yeah.
Well, under the current law, the way it's set up, it's automatic. Or you shouldn't say it's automatic. It's easy. All you have to do is file an estate tax return claiming that 11.5 million goes to the other spouse.
And again, that's why we turn to a professional, right, who dissects this and dives into this, because a lot of times we're just not going to pay that much attention. And I think sometimes that's kind of what government hopes for, is that we're not really keeping that close of an eye on it, but hopefully we're working with someone who is, like yourself. And I know there's a ton of stuff on here we've kind of got highlighted, so we'll try to move through as many of these as we can. But let me jump to this one real quick, because you've got it in a different color here. So the first-time homebuyers tax credit, that seems a little strange.
Yeah, that was one of those things when I was looking through. It's like, okay, I guess I don't understand that. The last time this came about was right after the Great Recession, when the housing market, housing market crashed, and it was an incentive to kind of stir people on to get out there and buy a house. Those that hadn't purchased yet. I don't know if you're familiar with the housing market as it is today, but it does not need any incentive right now. It's just going crazy. So that caught me by surprise as to why that would be in there. Why the incentive?
$15,000 for first-time home buyers. I wonder if this is part of that to help more disenfranchised or things of that nature who
it could be
maybe need help getting into a first-time home, and to try to, from that sociological standpoint of trying to pick things up. Maybe. What about the corporate tax rate going from 21 up to 28? Is this where it was under the Obama administration? Before, was it 28?
Yeah, so he's taking it back basically to what it was before, which, there's pros and cons. The argument is, let the big corporations pay for it.
Yeah,
they can
7
afford
doesn't sound that much. 7% doesn't sound like a huge deal, but on, $2 billion.
Right. Well, but if you start to look at kind of worldwide corporate tax rates. I mean, the US was in one of the top tiers of tax rates.
Right.
So it explains why a lot of companies figured out how to send a lot of things overseas, offshore.
Yeah, sure. Yeah.
I mean, they're for profit. They're looking to save money. And if there's a way they can manipulate and reposition to do that, so with the 21%, it did help bring some of it back, or we're starting to.
Yeah, it makes me think about that story that Apple had done where one of the big wins was like $250 billion, I think, was sitting overseas, and they were not going to bring it back into the U.S. until this got done and lowered, and then they did. I mean, 7% might not sound a lot, but it's a lot to $250 billion.
Well, but if you think of it in another, I guess, way of looking at it is, at 21, that's a 33% increase, right? You're going from 21 to 28. That's a 33% increase in your tax.
Yeah.
It's only 7%, but it's a 33% increase.
Yeah, no, that's a great point. Yeah, that's a much stronger.
It's a big increase in tax.
It's a big increase. So, okay, fair.
Now, I mean, kind of the barb, so to speak, that he has in there is now he's got some penalties for taking things offshore.
Gotcha.
But I mean, at the end of the day, corporations need to pay their fair share, but they are the core of our economy, and if you start taxing and taking away from them, it's all trickles down. I mean, that's just economics 101, so don't look at them as the bad guy that we got to take all the money from them because you don't think it's going to affect you. Just see how that happens.
Yeah. Is that the 10% offshore manufacturing you were talking about? Is that the little barb?
Yep. Yeah, so they've got a bunch of penalties, so to speak, on the corporate side for if you don't, and then some incentives on the made in the USA side.
Yeah,
so and that's great. I mean, I'm all for bringing as much of that back onshore as we can. But so again, we'll have to see how that plays out.
I'll see how it plays out. What about the equalizing the tax benefits of traditional retirement accounts?
Yeah, so this is one of those. Again, it's a highlight, right? What does it mean? Who knows?
It sounds a little vague
because it's really vague. So, I mean, I've heard everything from they're going to eliminate the whole concept of tax deferred retirement and just go back to some kind of a saver's credit, so what does equalize the benefit of traditional retirement accounts? I mean, I my guess in looking at it is more the thought of, again, well, the wealthy Americans, they're the ones that have all the money in the 401ks. So, for the lower end of the population, they can't afford it. So let's equalize that. Let's give them some kind of a credit, maybe take away some of the benefit to the, upper end. So are they going to put even more restrictions on how much could be contributed, or are they going to start? I mean, it wasn't too many years back that there actually used to be an excise tax if you had too much money in your retirement accounts.
Huh. It seems seemed to fly in the face of the Secure Act, which I'm pretty sure was pretty bipartisan, So that seemed to fly in the face of that because it's about setting every community up for retirement enhancement. That's what it stands for.
Right.
So, interesting. Yeah.
And again, I mean, these are all proposals. What actually happens, who knows? And by the time they negotiate and
any of it, all of it, none of it, right.
Right. What this really looks like, who knows?
Any other major points that you wanted to bring up on this, Phil, that you saw that stuck out to you?
No, I mean, those are some of the big points, Okay. So again, no kind of mass tax rate changes or things planned.
Right.
At least based on what we have here, what he's given as bullet points, he is primarily targeting that income, 400,000 and above, people earned income at that level or above. The big piece I think to really pay attention to is the capital gain side of it. So that step up in basis, I fully expect that to go away at some point.
Yeah.
It's always been too good to be true because, everyone in an estate from 0 to today, 11.5 million,
right,
are basically getting any gain wiped away for free because their estate isn't subject to tax.
Right.
So with this, they're trying to say, well, that's not fair. So let's tax all those estates, and then lower the estate tax level to capture more from money that's going to be transferred. Because I mean, they're no dummies. They understand baby boomers are aging and going to start passing away, and there's a lot of wealth to be transferred. So they want their piece of it as that happens.
Well, and it's again a great way to generate more revenue for the government to handle some of these things that we need to pay for, and whether you think that's going to go into different different things for society or just paying down debt or whatever, that's not really here or there. They don't make money, they tax money, so
that's right. The only revenue they have is tax. So they have no product or service that generates revenues. So
even the Secure Act, I mean, in that as well, while there's some things in there that are helpful for helping people get better prepared for retirement, there's also pieces in that were designed to help generate revenue for the government.
Absolutely.
By allowing the RMDs to go later. And matter of fact, I think right now, Phil, we'll probably get to this in a couple of weeks, is I guess some possible revisions to that. They're calling it Secure Act 2 or 2.0. Right. Maybe even moving it from 72, which they just moved it from 70.5 to 72 for RMD. 72. And now 75 is now on the table. And you think, well, that's great because I don't really need the money. Think about the other side of that too. The longer you let that sit there and grow, the bigger your tax bill is going to be when it comes due. So,
right. I mean, and that's the piece that a lot of people don't think of long term, right? So we've talked a lot about financial planning and running the numbers out. Well, this is all great, but if you pair that with what they've done to the inherited IRAs now, that beneficiary can no longer stretch it out over their lifetime. They have to take it all in 10 years.
They want the tax money.
So I mean, if they're taking on your side the RMDs and pushing it out further and further, so your account's bigger and bigger now. So now it gets inherited. It's a bigger asset that your heirs have to inherit. By the way, they've got to take it all in 10 years. And when does that typically happen? When those heirs are in their peak earning years, right before their retirement is, if you run the math out, typically when it happens. So they're already in, near the top of what their tax brackets might be.
And it may
now you layer on all these inherited IRAs. They're no dummies. They know the math. They've run this out. So don't think that they're benefiting you by, Now, that being said, as with any tax law, there's advantages. So
there is.
They're going to put it in there, take advantage of it, understand what they're trying to do and play their game of, okay, that's great. I've got an extra 2 years, 3 years, if they take it to 75 of, no RMDs, that I can do more Roth conversions before I get to that. And then my heirs, when they inherit a Roth IRA, it's tax free. Even though they have to take it in 10 years. So, I mean, you can play their game.
Exactly.
And work with the rules that they have, but don't let it just happen.
And as a CPA, I mean, obviously you've been doing this for many years. That is the nature of the whole thing, is the rules are set. People then figure out how then to maximize it to best of their strengths.
Right.
Or they change the rule, because that's why they take things out. We talked before about loopholes. There really isn't loopholes. It's just the rules are there. It's just choosing to figure out how to best utilize them to your advantage. And once they realize that that's not working for them anymore, they'll change the rules. So
I mean, you have to look at it like a parent and a kid, right? I mean, you can remember if your kids are growing now, you'd make up some rules and your kids would figure out, well, but you didn't say this. So I mean, that's what a loophole is. I mean, it's not that they left it in there for, it's they didn't think about that.
Exactly. Or just as simple as, putting the cookies in this particular, cabinet. Eventually you get big enough to reach that cabinet. They got to find another cabinet.
That's right. Yeah. It's just a matter of, and that's what we work with clients on all the time. It's okay. Here's the rules. You can't change them. They are what they are.
Right.
But what did they leave in there? How can we work it to our advantage?
Exactly. All right. Well, there you go. So that's just some of the proposals that that Joe Biden has offered out there, and that's some of the documented information that kind of go through that. Again, some of it may happen, none of it may happen, all of it may happen. It all just depends on what happens in voting in Congress and passing things and so on and so forth, just like any other administration. So that's going to do it this week for us here on the podcast. If you do have questions, if you do need a little bit of help about how to maximize things, or how you want to see if your retirement plan is working for you, get a second opinion, or just get a plan because you don't have one, then reach out to Phil. Share this message with others. If you're working with Phil already and you know some folks who might benefit from that, do us a favor, share the podcast with them, whether you're checking it out on social media or YouTube, or you've gotten it through Phil's email blast or whatever. Forward that to a friend, share it with a friend. we'd certainly love to have them come check out the show as well. You can always call Phil if you've got questions or concerns at 248-888-7530. Before you take any action, you should always talk with a qualified professional like Phil. He is a CPA and a personal financial specialist with many, many years, almost 30 years of experience doing this. So reach out to him, 248-888-7530, or go to philstaxhacks.com. That's philstaxhacks.com. Don't forget to subscribe to us on Apple, Google, Spotify, iHeart, Stitcher, so on and so forth, YouTube. And we will see you next time here on the show. Thanks for watching Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.